Welcome back to some more multiple choice questions. Today we're running through our basis and holding period of assets. Let's dive right in. And it looks like our first question here is going to deal with involuntary conversion, involuntary gain or loss, and recognizing gains and losses and what's the new basis of this asset. And it looks like Dawson Inc.'s warehouse, which has an adjusted tax basis of $75,000, was destroyed by a fire. Sorry to hear it, Dawson. The following year, Dawson received insurance proceeds of $195,000 and acquired a brand new warehouse for $167,000. Now, Dawson elected to recognize the minimum gain possible. What is Dawson's basis in the new warehouse? Great question. What are we going to need to focus on? We've got a lot of important numbers here, and we elected to recognize the minimum gain possible. We want to defer that gain to a later date, right? We are using these proceeds to purchase a new warehouse. It's not like we're taking these proceeds and running off and using them for whatever. This is the best tax efficient process. If you see a question where they're using insurance proceeds to repurchase a new asset that was destroyed. So what is going to happen here? We are actually going to be able, because, like I said, because we use those proceeds and purchased a new asset, we are going to be able to just carry forward that $75,000 into the next year, into the foreseeable years. That's going to be the basis of the new warehouse. Now, what's going to happen, right? We're deferring this gain. We're going to recognize gains in the future when we maybe eventually sell the warehouse or depreciate it and dispose of it. But for our purposes, what is happening? We are just simply recognizing that new adjusted basis of $75,000. Moving on next, we've got in year 4, a taxpayer gifted an undivided 1/2 interest in the taxpayer's farm to the taxpayer's children. Very generous of them. Title to the farm was held by parent and child as tenants in common. In year 10, the taxpayer died and the other 1/2 interest in the farm was left to the same child. The taxpayer paid $40,000 for the farm in year 1, and the fair market value of the entire farm was $100,000 at the date of the taxpayer's death. We see that an alternate valuation date was not elected. What is the child's basis in the farm after the taxpayer's death? Great question. Gotta love how morbid everything is here. It just makes the job, makes the studying experience that much better, right? Talking about all this death, all this great stuff. Continuing on, how are we going to calculate the child's basis? Well, first, we are going to use the original purchase price of $40,000 because that's the original basis. Good place to start. That was the original taxpayer's basis in year 1. We say $40,000, and then, well, what other information do we have? We've got the fair market value of the entire farm at the date of the taxpayer's death, which is $100,000. Now, what happened prior to this and throughout this period? Well, it looks like we had some division of the ownership here, an undivided 1/2 interest in the taxpayer's farm to the child. What happened? We had this total gain of $60,000. As such, the child was entitled to half of that. The child was entitled to $30,000 of that appreciation of the property. We see, again, where do we get that? We got that from the difference between the new value of $100,000, the original purchase price of $40 is $60, and then half of that is $30. All right, where do we go from there? Give you a second to think about it. Going once, going twice. Well, we are going to take the original basis of $40, and we're going to add that $30,000. And why are we adding that $30,000? Well, because this was already a recognized gain. And what's the relationship between recognized gain and basis and all of that? Well, we know that the higher the basis, the less tax you'll have to pay in the future. Because if the child goes and sells it for $120,000, well, the child, just like anyone, would want a higher basis because the taxable amount is the difference between the selling price and the basis. And since the child throughout this period has a $30,000 gain, we are going to add that amount because also just remember, generally basis carries forward. The donated, gifted, inherited property is going to have the same basis as those before. So we see $40,000 plus $30,000 is going to give us our answer of $70,000. That's it. That's all there is to it. Keep powering through. Keep answering questions. You got this. Get more multiple choice questions done. Just a reminder to see as many sims as possible. Those are always underestimated, so make sure you're seeing just as many sims as you are multiple choice. Have a great rest of your day, and I'll see you in the next one. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material.
We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.